Well, good morning. I have today here, I'm interviewing Dave Gretta. He's author of Night Trading, which I found to be a very interesting book. I crammed and finished it this morning. It was very fun read and very informative read. Dave holds an MBA in finance, and he trades by night and is an IT director by day, or IT, he's in IT by day. And we have a lot of good things in store, especially for people who are just starting out in investing or want to take control of their finances. So Dave, thank you for coming today.
Thank you for having me, Tanya.
Great. Well, we have two different backgrounds, or we have similar backgrounds. We both started investing in the 80s, and I did more drips and just a general beginning knowledge of stock investing, but had a great interest in it. But as you said in your book, before you start investing, to make sure that you don't have credit card debt or things hold over your head that you need to take care of first. And so that's what we were working on in our lives at the time. And so we started probably in the early 90s, but you started in the 80s and you have an MBA in finance. Can you tell me how that's helped you in investing?
Yeah, sure. I don't want to make myself sound too old. I actually started most of my investing in the mid 90s, but if you read my book though, in the 80s, I was extremely young. I was a teenager. That's when I bought my first stock. But yeah, so I would say you kind of keyed in on the foundation of how I invest and what I think would set me apart from most people. I do have a master's in finance, and I did get straight A's in intermediate accounting. So I think a lot of, most of investing is really looking at the balance sheets and income statements of companies, and seeing if the company is profitable. So one of my first jobs, I was an accounting manager. So I'm very adept at, which I've also shown in prior podcast interviews I've done recently, is that, digging through the financials and, looking at the price to sales ratio, price to earnings ratio. And because ultimately it gets down to, I don't know many stocks that have gone up over time where the company was unprofitable for decades. I mean, eventually it just comes down to earnings. So, you need to be able to read financial statements at some point.
Right. When I first started investing, I started with the National Association of Investment Clubs, and they taught you financials and how to read a financial statement and so forth. So that brings me to my next question. So what about people that don't have an MBA in finance? Now, you're very involved in teaching our youth financial literacy. And what I found, how I started investing, was my husband worked for a company for 12 years and invested in their 401k. And then when he left the company, we were stuck with the decision of managing it ourselves or handing it over to a financial advisor. And I felt like, this is my money. I want to know what's going on with it and how to invest it and how to manage it. And so I started managing it myself. And I asked a neighbor next door, and he told me to join he was a trader, but he said, don't start trading. He says, I want you to learn the fundamentals first. And so he sent me to the NAIC. But what about people who don't feel like they have any literacy in this area? I found your book to be a very good book for anybody that's starting in the investment realm, or anybody who wants to take control of their money. So can you talk a little bit about that and how somebody can become financially literate and take control of their money?
Yeah, sure. Even though I just said, it's helpful to, I have a master's in finance, I've worked in accounting, but it's definitely, you don't really need to have a master's or even an accounting degree to be successful in investing. You can just look at a few, I go over these, and I did a podcast interview where I just talked about, you want to look at some of the key ratios. So I look at, the price to earnings ratio, which, and also price to sales ratio, which values a company's market cap. So Really, you can really learn some of this stuff even just by Googling it. But by no means do you have to understand, what amortization is and depreciation, how it works, and anything that specific. It's helpful. But at the end of the day, financial statements by themselves are very open to interpretation. I mean, if you sit and look at any company's 10K or annual report, the first 20 pages of any annual report or 10K are just all the risk factors of a company. Matter of fact, most people, I tweeted recently, most people will get depressed if you really looked at the first 20 pages of any annual report. I actually advise not reading it because it would scare anyone from buying any stock. So
Like looking at your the insert on your pharmaceutical drug.
yeah, I mean, there's so many risk factors, but at the end of the day, Tanya, it really just gets down to profitability. I mean, one of the main things that the way I invest is, I think 99% of stocks are pretty much uninvestable and, pretty much garbage. And I've had, some really high value investors tell me this on Twitter, so that have published books and sold millions of copies, that, in my mind, there's very few investable stocks out there. And I try to just invest in companies that are profitable or near profitability.
Mhm.
That narrows down the scope of stocks that you would invest in. So a lot of it just gets down to profitability. That's quite, and that's quite easy to find. So,
Are all profitable stocks going up in value?
not yes and no, mostly. I think most stocks, though, even Mark Minervini says this. I mean, 80% of stocks move with the market. So this is the way I invest, is that even though my book was all fundamental analysis and the mental part, but as you'll know, I didn't put any technical charts in my book. And the reason I did that was for two reasons. One, I wanted my book to appeal to, high school students, college students, people that are even starting investing. But really, I didn't include any technical analysis in my book, which I could have, but because mostly investing should be for the long term. So, if you're really investing for the long term, you don't really need to look at a stock chart necessarily, because you're going to be holding it for 10, 20, 30 years. So, yeah, I mean, I don't want to make investing sound simple, but just to look for profitable companies. But that's a good starting point.
Good. So you're involved in teaching at financial literacy at the high school level. Do you see a big interest in youth in learning to invest?
Yeah, for sure. I just did a tweet, I think last week or this week, that really summed this up very simply. The night before the 1929 stock market crash, only 2.5% of people in the United States actually invested in stocks. Fast forward to today, almost 60% of people in the United States own stocks. So, it's something that, there's a high interest now because there's just more people involved in investing. At the high school level, I've been very surprised, though. A lot of kids, I walk in and there's like 16-year-olds there, and some of them have their own trading accounts that their parents give them, and they're quite, into investing. I mean, who knows? They might even know more than I do about investing, but some of them. So, but that could be a good or bad thing. I mean, I don't personally think in high school you should even be trading stocks. I mean, I bought one stock when I was in high school. That's what kickstarted my career, but that was just one stock. I don't really advise, anyone, because the thing is, you need money. I mean, like I say in my book, you can't buy stocks with a credit card. So I don't know in high school if you're making enough money, or even in college. I wasn't making any take-home money to invest in stocks. I didn't invest in stocks till I was after college, so which probably makes more sense.
Do you think that the 60% who are invested in stocks, do you think it's due to index funds or general, their 401ks or simple IRAs?
Yeah, I would say so. Yeah, definitely.
Okay, and you mentioned in your book that this generation will have a transfer of wealth of trillions of dollars that will probably come into the stock market. So some of these young people really might end up with some money that they would need to know how to manage, correct? Do you find that true?
Yeah, absolutely. I talk in the book about I cite studies that people, do this for a living. They look at secular bull and bear markets. Hopefully it's a secular bull market, where, just they study the demographics. And I think our generation, and even the younger generations now, fortunately people eventually die. So there's a lot of inheritance money that will be passed down. However, with this recent stock market collapse the last couple of years, I'm sure people's inheritance went down a lot. So
right, sadly. Let's see. Do you think everyone should take? Okay, we already talked about that. You talked about the difference between buying and renting a stock. I think we've gone over it a little bit, and we'll probably go over it some more. But can you explain that? Is that technical versus fundamental analysis, do you think? Or do you think it's a day trading versus long-term mentality?
Well, I think in the book I touched on how, at least speaking for myself, the way I invest is, I'm not saying it's for everybody, most of my investments are long-term. 70% of my portfolio is dividend stocks. So, but however, I do talk in the book about, kind of grazing, as I call it, like an animal or a horse. Sometimes I have a small part of my portfolio, maybe 20% or 30%, that I regularly do. I would say trade. That in that case, I do use technical analysis. Just because I didn't talk about technical analysis in my book doesn't mean I don't understand it. I use it probably 15% of my overall thesis. So I use technical analysis to look at how low a stock could go. I'm not concerned about. I want to make sure. I think the most important thing is really, people might argue this, but buying a stock is the most important thing. So I will look at stock charts, and you'll see me tweeting them out occasionally. That I want to see how low a stock could go. So I'm going to try to buy it low. I don't really care how high a stock could go, because technically any stock can go to infinity. So I'm looking to when I buy it, to buy it when it's relatively low as compared to where it's traded in the past. So and then, as you'll see in my book, I know when to get in and out of things. Like I got out of, as I talked about in my book, I owned Bitcoin, but then I got out of it, around 52,000. So, there is, the aspect. My book really explored it because I was referencing one of my friends that's a day trader, and I'm a night trader, which is more long term. So the dichotomy of long night trading and day trading, a lot of times. The day traders, and I know I have several friends that do it full time. They get in and out of. They don't really necessarily lose a lot of money because they get in and out so fast.
Right.
And there's advantages and disadvantages of day trading and long-term trading. So, so I know when to get in and out, and I know the part of my portfolio that I don't touch.
Right. Because you said there's some stocks, which we'll talk about that later, that you hold for a lifetime, which I found very interesting.
Yeah.
For people who do not, you say you spend 3 hours a night studying. For people who do not want to spend 3 hours a night studying, but they still want to be in control of their finances, what would you recommend?
Yeah, that's a good question. I think in the book, I would say up to 3 hours. Now, I'll be honest with you, I found recently that the quality of what's on financial YouTube, and I reference all the YouTube channels that I prefer that are free, to find this investment information. But I think you can get overwhelmed with that too. So you want to really be specific. There's only really a few YouTube channels that I actually watch now. I like the Josh Brown, the Compound. I think that show's one of the best. So that's one I'll watch, but I really limited to a lot of and then I watch CNBC. If you go to YouTube, like they're snippets at the end of the day. So they'll have like 3 or 4 minute summaries on, if you go to your feed on CNBC and YouTube. I find those useful because you can just scroll past it really quickly. And then if I find stocks I like, I'll sit and just look at them, and you can Google things and you can see what other people write. I try not to do the heavy lifting. One thing in life, the way I live my life and the way I invest is, I think Einstein said this. He said, there's people that avoid problems, and they try to learn from their mistakes. But I look at it. I try to avoid problems rather than solve problems. So I am always looking to, you know, put my time into just avoiding investing problems, and even in life in general. That's how I live my life. I mean, yeah, people say you can take your lumps in life and learn from your failures, but wouldn't you want to just avoid things that, that could cause you to fail? So that's how I kind of look at investing. So I try to stay away from the dangerous things.
Right. So would you call yourself okay, there's a couple of different things here. First of all, I see you somewhat saying you're a value investor, but you do have a speculative side where you allow a certain percentage of your portfolio to invest in speculative cryptocurrencies or SPACs or other types of investments. Is that how you allocate?
Yeah, I mean, SPAC, really, I talk about SPACs in my book. I mean, a SPAC, a lot of investing now is just wording. I mean, if you look at it, a SPAC really is just, I talk about this in my book, it's just an IPO, just a fancy word. So while SPACs kind of are going, are going away, nobody's really doing them anymore.
They were big in
yeah, they were big.
2021 when you wrote the book. SPACs were.
Yeah, exactly.
And I learned a lot. I learned a lot about SPACs reading your book. Thank you.
Oh yeah, but again, a lot of this is where you can't get trapped in Twitter, FinTwit, and YouTube now. A SPAC, it's just a fancy word for an IPO. It's just that's really all it is. So SPACs might go away, the wording of a SPAC, but it doesn't mean IPOs are going away now. Right now, there's not many IPOs because of the market now. So yeah, I mean, if you call speculative investments, I mean, I look at things. I like to take calculated risk. I mean, as everyone knows, I'm a big investor in Celsius energy drinks. Some people might call that speculative, but I don't. Like because I go out everywhere I see it, it's growing like phenomenal. So I don't even look at that or even Tesla as speculative. I look at those as that are really going to, long term, going to be good companies.
Like Amazon.
Yeah, well, Amazon.
I invested in Amazon in 2013, but I was one of those ones that I got into trading in 2018. I sold it at $1,800. I had ridden it all the way up, but if you would, let's go to that. If you would have looked at the fundamentals, all the analysts at that time and the PE ratio, when I invested in Amazon was through the roof. No analyst would touch Amazon at the time. They said, oh, Amazon doesn't have earnings. Same thing that they were saying about Tesla when I invested in Tesla. So what do you say to that?
Yeah, good question. Well, I would say this, what I said in my book is that you don't need, this is very important. You don't need to be the first investor in Amazon. I pointed this out in my book, or Tesla, or any of these other, or Google, I can name any successful stock over the last 20 years. And you might not even want to be the first investor, because if you invested in Amazon or Tesla or Google, even let's say 5 years, or even up to 10 years after they went public, you could, as long as you get on the train even later, you don't need to be on it early. So the fact that you or someone else sold Amazon early, like my friend did in my book, I described, he bought Amazon at 80, and he's a day trader, and he sold it 85, 20 years ago, and he thought he was doing great. Even if he would have held it, he'd be, worth $20 million. So, however, the flip side of that is if you even bought Amazon years and years after that and just held it, you'd still do really well. You might not make 20,000% return, but you might make 10,000%. So, yeah. So,
how would you know when to sell a stock like that? For instance, Blockbuster, Netflix disrupted Blockbuster, and Blockbuster went to zero. So Blockbuster at one time was considered a very a stock that you would want to buy and hold forever. But then when Netflix came on the scene, Blockbuster crashed. And so there's disruptions in technology and disruptions that can take place that can displace a stock. So how would you as an investor know how to gauge that and how and when to sell?
Well, as we know with stocks, you really don't. I talk about this in the book. I mean, people in FinTwit say don't fall in love with the stock. But however, if you I say the opposite. I like to fall in love with most of my stocks that I own because then I'm not as tempted to sell them. I mean, are you going to go out and sell your house next week if the housing market goes down? No. I mean, that's how I look at it. So
Right.
I would only really sell a stock that I've researched that's in my long-term portfolio, which is the majority of my portfolio, unless if there was a fundamental breakdown in the company, in the
So
business.
that's where you would look, fundamental breakdown. And
Yeah, I mean, I'm going to use Celsius stock as an example, the energy drink that I talk about a lot. That I got vilified on Twitter, last year when I didn't sell it when it was 115. I didn't sell any of it because I think the stock's is going to go to 180. So I had people like tell me I was stupid for not selling Celsius or even Tesla as well. So you have to like really be, but then if you need money or something, but I don't really need the money for some of these stocks, so I'm just going to stay in them. And I tell you right now, I don't think in the near future this year, hardly any stocks are going to be going up a lot. So maybe sideways, but not necessarily up. So I'm not looking right now to even buy or sell anything. I'm just, it's a good time, I think, this year. Not financial advice, but it's a good time really to just, truly do nothing. I mean, don't all these people tell you like most of them investing just waiting and doing nothing? I think 2023 is that year to actually, as tempted as people are to buy stocks that are low now, this is the year to maybe go out and go golfing for the rest of the year, which some of my trader friends have already done. So,
or as Jesse Livermore would say, go fishing.
yeah, go fishing or golfing or do something else besides buy stocks.
Right. You made me think of something here. Anyway, so you're in the Twitter space, and how do you feel about, why are you there? What do you think about transparency in the Twitter space, and how do you handle the imposters?
Yeah, well, like I said, I think you have to take the good and the bad with Twitter. I've looked at other platforms. I just joined Twitter not even 2 years ago, so I'm relatively new, and I'm actually thankful I haven't been on Twitter for 10 or 15 years. I think Twitter is a giant distraction. I love the platform. I think it's even better than Instagram. I'm not even on Instagram. I mean, I'm just really on Twitter. I think the platform from a technology perspective is exactly what I want. The video part of it, the Twitter Spaces, et cetera. So it's a good place for me to promote my book, and it's really right now the only place that I'm really. So I'm all in on Twitter, and but I do find it as a giant distraction. I talk about this all the time. So you can learn a lot in Twitter. However, you can get distracted. And I think most of it is a distraction. I would say 5% of Twitter, that the financial advice or information on Twitter is actually valuable and useful. Mm-hmm. So that means 95% is not. You just have to, and the 5% that's valuable on Twitter is better than, I've worked across the street from Wall Street, as I talked about in my book, but I'd say the 5% of Twitter, FinTwit, is actually better than most in Wall Street information. I mean, it's that good. So you just have to be able to, I mean, you can learn so much on Twitter, FinTwit, just for free. I've learned an immense amount of information. Matter of fact, I think I just estimated almost 25% of my stock portfolio now is because of people I've met at Twitter investment conferences, or even just followed on Twitter. I've gotten one fourth of my stock portfolio right now, as we're speaking, is from Twitter.
Wow.
Yeah.
So it sounds like you hold a lot of stocks in your portfolio, and also you invest in ETFs. What is your balance of stocks to ETFs per se?
Yeah, that's a really good question. So I even did a podcast video on this about diversifying how many stocks you should own. I personally own about 19 stocks, individual stocks in my portfolio now, and I think that's too much. Mark Minervini talks about diversifying, DIW, instead of diversifying, he calls it
right.
Diversifying your portfolio. Also, Peter Lynch, that I reference in my book, every stock you have is like a child. I mean, I have 2 children, and that's enough babysitting for me. But every stock, so I have 19 stocks. It's like really having 19 children. I've met someone at an investor conference last year. or 2 years ago, he told me he has 98 stocks in his portfolio. I haven't heard from him since. I'm sure he got most of his portfolio got wiped out in last year. So yeah, I don't, and a matter of fact, yeah, I think it's one of the worst mistakes in investing is to own too many stocks. I actually think if you own over, and this is proven by Peter Lynch and Mark Minervini, they both say to own about 10 to 15 stocks is the ideal. So I think if you own over 20 stocks, which I never will anymore, I always want to keep under 20, your chances of outperforming even the S&P are zero, like literally. Each stock you own over 20 individual stocks, I think you have a 0%, because then you might as well just be an index fund yourself.
Exactly. Exactly. And that was one of my questions is what do you use as a benchmark? Now, I've always used the S&P as a benchmark, and it looks to me like you use the S&P as a benchmark. And I remember when I first decided to take over our finances, well, the second time I took over our finances, because we did hire a financial advisor at one point, but my husband said, if you can beat our financial advisor, then I want you to manage the money. And so that's how I got into managing our money the second time. But I always use the S&P as a benchmark, and it's something that I tell people. Now, I don't think every financial advisor, I mean, they say that most mutual funds cannot outperform the S&P. How do you feel about that?
Well, that's a very good question, and one of my favorite topics. So you have to keep in mind the S&P, the beta or volatility or risk, as we can call it, of the S&P is the benchmark is 1.0.
Right.
Well, guess what? That's the risk of the market. It's not zero, it's 1.0. So that means the S&P is by nature, it's not like it's not risky, it's as risky as the market. So technically it's very risky. You might, as I talk about in my book, I did a study on this, which I proved that you might, instead of the S&P, you might want to compare your investments to Hershey Foods investment, which is what I did in my book and proved out. So I took, anybody can do this, there's free websites out there. The last 15 years, let's just say 2007 to 2022. Let's look at the S&P returns versus the return if you just put all your money for those last 15 years in Hershey Foods stock. Well, guess what? Hershey Foods outperformed the S&P. Now it's a very small amount. It's 0.00 something. It's small, but it did. And that's the fact. And guess what? Here's the kicker. Hershey Foods outperformed the S&P, but with way less risk, because the beta of Hershey Foods, or the volatility, is 0.35. Well, the S&P is 1.0. So you could argue that all these people that, and I'm not saying don't invest in the S&P 500. I'm not saying that by any stretch, but I'm saying if you just compare that, nobody's ever thought about this, because that's all we've been ingrained to. People have pounded into us. The S&P, just put your money in the S&P. Well, if you just put all your money in Hershey Foods, you would have outperformed it. But here's the kicker: with way less risk, because the data of Hershey Foods, I mean, unless, an asteroid hits Earth, people aren't going to stop eating chocolate. So, and I joked recently about putting all my money into, taking all my money just putting it all into Hershey Foods.
But could Hershey's be disrupted? I mean, it's still a stock, and it's still, you could get a new financial manager, change presidents. Some new diet fad could come out that says don't eat chocolate. I'm sure they own that.
If I was going to take a bet on something failing, I would not bet against Hershey Foods. And matter of fact, here's the thing: my study in my book was only the last 15 years. But guess what? Just take 2023. Look at the S&P returns and look how much Hershey Foods just went through all-time highs yesterday. So I'm looking pretty good on the analysis so far.
So you say to always buy a stock low, or you always try to buy a stock low. This is not financial advice, and I forgot to give the disclaimer at the beginning that nothing in this podcast is financial advice. So please do your own due diligence and seek a financial advisor. But you said that you basically value investing. You want to buy something at its lowest. So would you suggest that somebody wait to buy Hershey Foods, or?
Well, I didn't necessarily say that in my book. I mean, I didn't ever say in my book to buy low. Now, here's the thing. This is a great analysis because, and again, Mark Minervini talks. I'd actually recommend, obviously I like my book for investing, but my favorite book is Mark Minervini's Think and Trade Like a Champion.
I'm in Mark Minervini's private access. I'm one of his members.
Yeah, I
By the
mean,
way.
he to
So
me,
you and I trade a different way. I used to be fundamental and now a techno fundo, but Mark Minervini looks at fundamentals too. So yeah.
So getting back now to Hershey Foods and buying a stock high, and this is a very good point you're bringing up. And Mark Minervini talks about this. He mostly buys his stock. He would love Hershey Foods because I know that, because he mostly buys stocks that are at or near 52-week highs. So, common sense or that most people on FinTwit tell you to buy a stock low, and that isn't always the case, because I never said that, because a stock that's low could go lower.
I thought I misunderstood you because I thought I heard you say it in the podcast. I thought
you'd like to, but I also analyzed buying stocks high. So Hershey Foods is a great example you bring up, because here's the thing. I talk about this in my chapter in my book on Hershey Foods, is that you're never going to find Hershey Foods stock. Go look, it never goes down. And the stocks of like a lot of very good companies like them, they don't go on a discount, because you know why? Because they're really great, excellent managed companies. So, Hershey Foods, I even said this, if you like a share, it's going up over $100 in just less than 2 years. So a couple of years ago, when I made a lump sum investment to Hershey Foods a few years ago at $175 a share. Everybody said, oh my God, at the time, it's so expensive. Well, guess what? Less than 2 years later, fast forward to today, Hershey Foods is almost $275 a share. So people today, like you or whoever, will be saying, well, Hershey Foods is expensive. And then 2 years from now, it'll be $375 a share. You follow? You see where this is going? It doesn't.
I would never say a stock is expensive, because I trade like Mark Minervini, and so I'm going to buy a stock when it's run up.
Absolutely.
I'm a trend. I would buy it in its trend while it's in a stage 2 uptrend.
Absolutely. When there's no overhead supply on top of it. So take a look, pull up a chart of Hershey Foods, and you'll see that it's up and to the right. There's no overhead supply like that. The stock's at it all the time. It could just keep going and going, which, they have competition. Yeah. I mean, I love chocolate. I love M&Ms, might be my favorite food, even though I own a lot of Hershey Foods. But guess what? You can't replicate a Reese's peanut butter cup. You can't replicate a Kit Kat, as I talk in my book. There's other alternatives, but you can't, they have a monopoly on those products. So.
Right. Well, I'll be interested in seeing what kind of dividend does Hershey's pay. You mentioned it in your book and it was amazing. So
it still pays like, even though the stock is like approaching, it's over $250, it pays like a little over 2%, which is not bad for a stock that high. So they always keep
one that's growing, one that's still growing. And
yeah, I met a guy last week. So I'm always around Wall Street. I went to a party last week. I think I tweeted this out, that he is only 27. He has a portfolio of millions of dollars, and he's 27 years old. And I was talking to him at a party just last week in Manhattan, in Wall Street, and he owns several $1 million of Hershey Food stock. So
good for him.
Tell you,
that's awesome.
Even young people, they're smart enough to know that this is like an investment.
That's good. Well, I'm going to definitely keep my eyes open on Hershey's and look for a good entry. So, you told the story of Buy the Bank. So we have an interesting situation with banks. And can you talk a little bit about how you feel this is going to turn out as far as bank failures or interest rates affecting banks? And you also mentioned that when interest rates go up, banks do well. Should they be doing well right now?
Yes. Well, that's the caveat. Higher interest rates, as opposed to, where they were at zero the last 15 years. I do analyze and invest in the banking. I know more about the banking, regional banks and banks than, most people out there. Higher interest rates short of a recession are good for banks. So we have to be clear about that. So yeah, of course, that's how a lot of banks make their money, loaning money at higher rates. However, it's a perfect balance. We haven't said the R word, the recession word, in the last 15 years. So That's the thing. Where I think banks are headed right now, I luckily, a few weeks ago, I got out of I sold all my bank stocks right when I knew, yeah, everything, right when it was right when it was hitting. But I since then rebought my bank. So the same bank in my book that I talk about where I made the most money I have in my life is that I just tweeted this out like yesterday again, is that there's a very narrow list, maybe 2 banks right now that I personally, and I invest in the banks that I'd even invest in, because nobody really knows that the balance sheets in banks now are like a black hole, meaning they have this thing called unrealized losses due to the interest rate differential. So right now, I think the only bank, the number one bank I would invest in, not financial advice, is the bank I talked about in my book where I made my money, is Citizens Financial Bank. Matter of fact, several analysts have also supported what I said. They said that's one of the better banks now. So I re-entered a position in CFG, Citizens Financial Bank, and but I want to buy a lot more, but I'm waiting. So right now, but think about this in my book. I talk about talking about the banks. You don't want to overthink in investing, but you don't want to underthink. So the thing about banks is, without overthinking this, if you had to think of one industry in the entire world or country and one sector that the government will not let fail, it's banks. Followed in second place by airlines. Think about this: when everything crashed in COVID, the banks, that's when I made all my money, because the banks crashed and then they ran up, massively. So the government's not people have to understand this. The government is not going to let. Yeah, they might let a few banks fail. I mean, Lehman Brothers and Bear Stearns. I think several dozen banks. Yeah, they failed in 2008. Now, so the government will try. That's the good thing about investing in banks, because if you know how to do it, because the government's not going to let our banking system collapse. So it has a backstop. So that's why I re-entered my position in Citizens, and the stock, even the last 2 weeks, the stock's held up pretty well compared to a lot of other stocks. So I'm going to keep adding to it as time goes on here.
So when you went into the bank, you were looking for interest on a CD or so forth, but now CD rates are very high on short-term CDs. Have you taken advantage of the Treasury market or short-term CDs since interest rates are going up and so forth?
Yeah, 100%. So I even talk about this in my book. It's still the same thing. Even though I say just buy your bank, that's a chapter in my book, which is really caught on fire. People call it just buy your life insurance company, just buy your gas station, just buy your restaurant. It almost has like it's just like a cult following.
That's good.
But yeah, I can tell you this quick story. I walked into my bank about a month ago, and I talked to the manager of the bank. And I'm not sure if you read my book, because I wrote the book about his bank. But anyway, I pulled all my money out of the bank, because in my book I said, buy your bank, buy the stock of your bank, but don't, it's really dumb to keep your money in banks. And I would say it's dumb to keep your money in banks now, because it's very simple. I pulled a pretty large chunk of my cash out of my bank about a month ago, because the bank CDs don't pay anything. So this is a little secret. Other people in FinTwit would have nagged me for this. You want to put your money into I have a lot of my money. I just pulled it out of my bank into a brokerage CD, which is through Morgan Stanley, I believe. So the brokerage CDs pay I'm making 5.4%.
And they're FDIC insured. At least if you buy a CD through TD Trade, I just bought one the other day. It's FDIC insured.
Yeah. You must have listened to my tweet, because I had somebody asking me.
No, I didn't.
Well,
I didn't. I was just looking for something short term to put some cash in,
Yeah.
So I only did in one of my accounts, but yeah.
That's smart. So would you buy a T-bill or a CD?
Well, I bought both. I bought T-bill, short-term 3-month T-bill, and a short-term 3-month CD.
Yeah, that's what everybody's doing. And in those cases, you don't need your bank. I mean, that's my point. Yeah. I mean, I pull my money out. So people don't realize this. It's but I'm telling you this, it's just common sense. People don't realize the brokerage CDs, which I have, pay way more than a bank CD. Banks aren't really quick to go pay you a lot of money on your, a lot of interest on your money, because, usually they only pay more interest if you're coming from another bank. But if you're an existing customer, they treat you like garbage at a bank because you can't get the rate that somebody just walked in off the street from another bank could get on a CD. So I get back to what I said in my book. Don't just buy your bank, or just don't put your money in your bank. Nobody's dumb enough to keep their money in the bank. I mean, maybe some of it, but it's really not a smart place to keep your money.
Exactly. And what's interesting, when I first started investing, I read something in one of the books, could have been a Warren Buffett book or something, I can't remember, but it talked about not putting all your eggs in one basket, where people work for a company and then they put all of their investment into that company's stock, and then all of a sudden they lose their job because the company goes under, and now they've lost their job and they've lost their investments. I know of a particular bank president, local bank president, that had his entire, the majority of his retirement in the bank stock. And this was back in 2007, 8. And that bank was one of the bank failures during that time. So he lost his almost entire life investment. What would you suggest as far as, I think if you're going to buy and hold, would you say that investors should diversify if they're going to buy and hold, be buy and hold investors?
Yeah, I think that's a good question. The way I look at it is diversification is this. I talk about it. It's even on the back cover of my book. I said diversify, diversify, diversify. But think about this. Diversification of your stock portfolio is not going to isn't going to prohibit you from losing money eventually. But what diversification does is it prevents you from losing a lot of money in any one particular sector or investment. Supposedly, I mean, you could lose all your money, but you have a lot less chance of that. So, if you do diversify. Now, I know people on FinTwit that they'll say they don't diversify. They say they own 3 stocks. They say, but really, if you dig deeper, a lot of people, everyone's diversified, because even that same person, I mean, I know somebody on FinTwit that I'm friends with, they mostly invest all their money in Bitcoin. Well, they haven't done too well, but that doesn't mean they don't have real estate. They don't have a few stocks. So, the word diversification can be interpreted in many different ways.
Right. Okay. Oh, okay. So in your book, you mentioned the Wheels Up. It was a SPAC, and you wanted to wait to see what happened with that SPAC to publish your book, but you went ahead and published the book anyway. What happened with the Wheels Up SPAC? And I just want to say, you mentioned you want the president to call you up and give you a flight in one of the jets. And you mentioned Tom Brady, and I'm like, hey, if I can fly in a jet with Tom Brady, I'm in. But can you talk about Wheels Up, the SPAC?
Yeah, love to.
What happened with it? Because I looked it up and it was 60 cents. So
I'm surprised it's that high. So yeah, what happened with Wheels Up is, and truth be told, I mean, I'm not gonna write, some people write investment books and only say about the winners that they had. Well, I'm very transparent. So Wheels Up, and I kind of made a joke about it in the book. So I did buy stock in Wheels Up because I was really of the belief, I live right in New York City here, and I've always been the belief that I've always hated airlines, like, going to the airline. I mean, who really likes flying? It's really so I would always look up when I'm walking, I see these private jets, like these Cessnas flying in, with probably billionaires on them. And I always dreamed about, like, wow, somebody could publicize private airlines. So that's how I started investing in Wheels Up when they finally went public. And I said, all right, this is my chance. And I bought the stock, and I used some of my, it was going to be a buy and hold stock. I thought Delta Airlines owns parts of them. So I thought Delta would just buy the company out. I said, well, this is going to be great. I made a joke about it, and I used to tweet the CEO on Twitter as I was writing my book, and I owned the stock, and I would almost like poke fun. I almost told him to hire me as marketing manager, because I saw things like kind of going downhill where they weren't really, it was still like this private exclusive thing where only wealthy people could fly on private airlines. Whereas that's how they market themselves, that, oh, regular people like us could fly private, because they would just allocate some seats that were open. And I joked around, because Tom Brady owns part of Wheels Up. So I was joking around, I like football. I'm actually a big fan of Tom Brady's at the time. So I joked around, like, why don't you get me, a seat next to them on your flight. I can promote the airline. And then since then, what happened to all SPACs? They and I actually predicted this. So not to I'm kind of defending myself here. I bought it as almost like a joke. And I did lose a decent amount of money in it, but not I did diversify. But and I did study in my book. So in my book, when I wrote my Wheels Up chapter, I cited a 57-page, if you read my book, a study done by Stanford University professor who's highly intelligent. He studied SPACs and said they're really not a good investment. So I referred to that in my book. So I kind of invested in it as a joke, and I knew basis these studies that were done that eventually, I didn't know it would go down like from $8 to 60 cents, but I kind of predicted it would go down. I knew it, unfortunately, but that's just me losing my money. I didn't
I'm
advocate.
sure you had a small percentage of your portfolio in it.
Yeah, but I still
You
lost,
did that.
several thousand. Like
Oh,
it
wow.
wasn't a small amount, but it wasn't like something that but the other smart thing is I knew when to get out of it. So here's the thing.
Yeah.
I bought most of my shares at like $7 of Wheels Up, but I sold it at maybe $3, and when it was around $3.50. So think
That's
about
good.
this.
You didn't.
Yeah, I know when to get out, because if I held it, I would be down almost 100% of my money, whereas I only lost about 45%. So yeah.
So you said in your book, Delta was a stock that you would own forever. And you mentioned that a couple of times in your book, owning a stock forever. Do you still feel that way, that it would be, you still feel like
Well,
there's certain stocks you should own forever?
yeah, I think yeah, well, here's the thing. I thought I would own all my bank stocks forever, and I sold all those a month ago. So
So you're
generally
willing to sell one of those whole forever stocks.
yeah, I did. Now, I several of them I didn't sell. I own several REITs. I own like Hershey Foods. I'm not going to sell. Hershey Foods also doesn't go down that much. So, if something changes, I mean, but I kind of do have that mentality. So, and again, it's not financial advice, but um, mostly people that let's even go back to 07, 08 crisis. Most of the time in investing, and a high level person, I retweeted this yesterday, even an investor that's worth millions tweeted the same thing out a couple of days ago on Twitter, is that even when things crash in 07 and 08, for the most part, generally speaking, if you had just didn't listen to everybody out there in 2007 and 2008, and you just did nothing, you just turned off the TV and didn't listen to any of the analysts on CNBC or Jim Cramer at the time or whoever, and you did nothing and you just sat for like 10 or 15 years, well, you would have been better than most people out of that, coming out of the 07, 08 crash. So
I agree with that. What I ended up doing, and it's funny because I didn't know Mark Minervini at the time, but a lot of times he'll say, if you sell half, you'll be correct either way. Because if it goes up, you'll be saying, I'm glad I only sold half. And if it goes down, you'll be saying, I'm glad that I kept half. And that's what I did in 2008. Everybody in my office panicked and sold everything that they had. And I had Apple and Microsoft, and I didn't have Amazon at the time. I bought it right after the financial crisis, but it really worked out in my favor to do that. So I understand exactly where you're coming from. I'm glad I held half through that crisis, and I happen to have some really good IT stocks, and it seems like IT really came out of that crisis quite well.
yeah, I think
The Googles, the Amazons, the Netflix, the
yeah.
thing, different stocks like that.
Absolutely. Getting back to your, just to end on this point about holding forever, you have to understand 70% of my portfolio is dividend stocks. So here's the thing. I am not going to sell any of them, because I can tell you why, unless there's some like really like major reason to sell them, which I don't think so. Because here's a simple fact. Even though we're in or going into a recession now, or something, something is going to go, the market's going to go down a little bit maybe. You have to understand so when you talk about buying, like holding forever, we have to differentiate between dividend stocks and non-dividend stocks, because dividend stocks, even during a rough patch, I'm still going to get paid, because so and then I just have to sit and wait for those dividend stocks to the value of the stock, the per share price to come back. But during a recession, if we go into one or a downturn, I don't care if the market goes down for several years, because personally, I'm still making money on my dividend. I'm even getting more shares on the reinvestment. So
Right.
as long as the dividend stocks I'm holding in my portfolio, or even your portfolio or anyone, as long as they're eventually going to go back up, you'll be fine. And matter of fact, you might be better off because you'll own more, you'll accumulate more shares at a cheaper price. So.
Right. Dividend reinvestment programs. Yeah. And not everybody wants to be a trader or trade in and out of stocks. And I wouldn't suggest it for my husband. It wouldn't be his cup of tea, what I do. And as I've gotten older, I've been more of a trader. I want to hold something as long as I can. I want to stay with the stock. I want to stay with the trend. And I can't say that I won't one day go into dividend paying stocks if I want to travel the world or something like that. It may be a good idea for me to allocate my portfolio that way, but I haven't. And I always wondered what William O'Neill did, because he wasn't a dividend stock investor. And I read in his book that what he did was he would take 6% of the portfolio a year. And he had calculated out that number. And if you are in trading and you do that, then that can be an idea too. But I think your method is great. I think anybody that would want to learn about investing and get a really good financial start in investing would do well. $20. I mean, this would be the best $20 they would ever spend. And if anything were to ever happen to me, I would really want my husband to read your book, because I would want him to be able to talk to his financial advisor. And this would probably be more up his line of investing. You know, I'm totally different. And at this point in my life, I can't say I always will be, but it was a really good read. And I thank you. And, you know, we didn't get to cryptocurrency. So there may be a part 2 to this interview, if you would be willing to come back and let's talk about cryptocurrency and the world of crypto. And
Well, I'm going to be talking about it in a few weeks in Chicago at our investor conference.
Are you?
Yeah, I have. I'll be giving a 1-hour speech on crypto, as well as I have one of the top crypto technicians in the entire country. He's speaking for an hour. So,
who is that?
His name's Sean Gillis. Yeah.
What coins is he involved in?
He's mostly in Bitcoin, and then what they call ICP, which is Internet Computer Protocol. So we're going to take a deep dive in Chicago in a few weeks at the investor conference into crypto. So yeah, I mean, maybe you or anybody else watching this can fly out to Chicago. So.
I might think about that. I've always
wanted
to go to Chicago, and maybe my husband and I would like to take a trip there. But yeah, there's a really good section in the book on cryptocurrencies. I thought it was great. I love the cryptos that you picked out, and that was another thing I wanted to go into. We don't have time today, but about the crypto. If you don't want to go to one of the exchanges or whatever, the GBTCs or the BITOs or the miners, the Maras and Riots and things like that, that you can buy on the within your investment account, within your retirement account, is one of the ways I invested in crypto. Did you ever do any of those?
No, I didn't do the GBTC. No, I invested directly into Bitcoin or into the protocol directly, but I don't own any Bitcoin right now. It doesn't mean I won't future.
Yeah, I sold everything too, but I'll be honest with you, I bought it back the other day. I bought some back. I think I'm going to be more of a buy and hold investor in that realm because of the taxes and that's a whole nother story. We can maybe get to that next time. So I want to thank you for being on my podcast today. And
thank you.
I
It's
really
been fun. I appreciate it. Thank you.
Okay.